S&P 500 60-minute chart. We are long the indexes, and we're going to talk about on a 60-minute level about how these double bottoms got put in over here. Because the double bottoms got put in here, we rallied up to point A. We pulled back to a knife hook breakout on a 60-minute level, so you can see it before I show you the daily. The important thing to understand is that with the constructive pattern over here, with the higher high, with that pullback and that knife hook reversal, we expanded all the way up to these high reversals, and we're at another high off of another bottom. We did not break that 1140 S&P that I talked about over the weekend. And I talked about why we were going to be net long up and out of the money index call options that hit 45 cents on the 1250 call. But what makes this a range-bound market and a bottom market on the 60-minute is that the big down reversal tested that. We didn't break it. If we would have broke it, then it would have been a different story, and we would have came down here. My point of it is that this reversal upside today on a 60-minute and from yesterday, and then that big follow through, that delta expansion back up to this half bar. This is what I said over the weekend. Go look at the weekend analysis on the S&P 500, and I talked specifically about 1190.23 on the half bar during that time, and I'm right above where that last half bar from that top reversal down short was. The constructive side is that we continue to come up in the volatility down, volatility up. The bottom was put in over here with the volatility reversal, with the greater high breakout on the S&P 60-minute. Here we have the beginning new process. We have levered up off of that 1145, 46 that I talked about, regaining that 1150 conscience, and we have up to the 1190.9 conscience, which is right here at the SMF at 1190.23 upside bar. Not only that, we talked about it very clearly and very passionately about volatility. Downside volatility, upside volatility. There's a lot of work to be done. And the highs that were reshorting up here a week and a half ago, when we were going up to this high delta reversal that we talked about, we hit that first pass. Now, this leg here, there's lots of headline events, but it is a reversal, and it's a nice one at that. We hit that 1136. We levered back up in that S&P 500. It's doing everything that a market should do in the price action reversals, okay? The thing about it is volatility is not a one-way street. There's a one-way going down one way, and there's another one-way coming the other way. It's a two-lane highway. The problem is when I'm looking at it, there is not a problem. You got the leverage up. You've got the bottoms in play. We called the bottom here. We called that short-term volatility reversal top. We had this over here. We went constructively long. We got out up toward the highs. We made a much greater high in the cycle, and now we're leveraging back up off of that same bottom point. Now, having said that, here is the daily shot of that S&P, and here's that double constructive bottom that we put bottoms, we rallied up, we reversed. This is a daily chart. This is the daily expansion. Now, what has happened is that within this bottom control panel here is that as soon as I populate all the diamonds, I'm going to be able to just to tell you that every time that the bottoms got put in, we made a higher high right here. We pulled back, we tested that area, we made a higher high than here. We have pulled back from that high and now have come right down to about that 1136, but that high is slightly higher than that one, and this is higher than that one, and this triple daily bottom is higher than that one. That leverage up, that expansion up to that reversal, upside volatility, downside volatility. These lines do not lie. Each one of these are, for today's pricing, is that I'm locked up a little bit, so when it's $6.62 is what it is. So I'm going to bring this back up. Now, as we take a look here, This is what it looks like on standard technical analysis, and you started to divergently put in double bottoms on the MACD. It's all standard stuff. It's not the platform you just looked at, MMT. This is just a standard. There's a 10-day simple movement average. It never did cross over on the way down. Even with that big pullback, that 10-day movement average was rising above the 20, and that's why we called for this double bottom upside. Not only did we call for it, we also own the call options behind here yesterday that were 45 cents on the 1250 call. Now, what I'm going to do, based on understanding the constructive bottom, doesn't mean that it holds. It means that we put the bottom in there. That was that big downside. We went long. We got that double bottom breakout up to there. Just as we said in the platform, we pulled back yesterday on that big gap down. We came right back in. The 10-day moving average was rising above the 20 during the 3-day pullback. That's told us when to get long these calls. They were 45 cents. The low of today is $1.65. The high is $2.75. 215 by 350. I have an exit on these calls traded 11,300 based on that bottom with higher highs. This is a very constructive bottom, headline driven. Got Obama's speech coming out tomorrow. Got austerity in Europe. Got all of that. That doesn't matter. What matters is that upside volatility within the constructive bottom, top one, top two reversal, reversal one, rally, reversal, the beginning of a new rally at this double bottom. I've got that low, much more constructive off of here. That low was very constructive off of this double, triple daily bottom that was testing here. Everything says it's a long shot, but you could trade right back up here. Here is a neckline before you would roll over again. Now, mind you that this is the upside volatility. And because of the amount of headlines and whatnot going on around the world, that is all true factual data. However, it is my experience that you cannot, take the doom and gloom of the truth of what it is. Volatility has a mind of its own. And the VIX and the vix.x, the fear indicator, which I will be happy to bring up on another daily chart here. But I'm going to put these orders out now for today. There's a lot of day left, but I'm going to put the ask out at $6.20 right here. Okay, we bought these yesterday. The low was 45 cents. There we have the amount of volume today is that 11,000 contracts people are moving in here, and the 10-day simple moving average is constructive at the moment. Just remember that the follow-through upside has to come back up into the resistance levels now, and that the divergence is building some momentum. That's how you get these upside moves in this extreme bear volatile markets. And you got to know that, and it's all short-term stuff, but the trend line is ascending that way at every bounce. You can't ignore it. These last highs here have got to be taken out. Just as that rally up off of here, that pullback, these highs were taken out right here. These highs were in the last cycle. So you would have to have a continuation move tomorrow, going into the Obama jobs report, going into the austerity in Germany and Europe and the euro and all. Hey, that's all good and well. But you got to remember that upside volatility and everything I said over the weekend was that in the very short term on the weeklies is that we hit an oversold condition in the shorter macro. Meaning that when we were short all of August and May, is that when we got down here to such levels of that, is that we would ascend up. And this is how shorter term yearly bottoms get put in. Some will hold, some won't. We don't know that part of it yet, but we do know that the upside movement is here and that we're up over 140% in the actual contracts that we bought. Once again, it's all about volatility, how to measure volatility, how to understand bottoms, how to understand where a turn could be at the very lowest price. They were 45 cents. That's called I got to buy it, I got to own it from yesterday. I had to own it for the upside volatility. My downside risk at that time of entry was very, very, very minimal. My downside risk was very, 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 very minimal. And why do I say that? I'll show you why. Here I have the 1250 call. And here, yesterday, And I have waited many months to get it down here where the contract are 45 cents. Right here, 0.45. It opened at 45. The high was $1.45. When we had the big gap down on Tuesday morning, we had orders at 25. We even had some people that had them out at 75 that never did change them to 25. We had some people at 60. It doesn't matter. Our entry here with some of our guys are $1.20, okay? Because we were forced to buy it on that up move. But you could take a look at that 1250 call. You could take a look that 1 day, 2 day, 3 day, 4 days ago, they were $15. And they went from $15 a contract down to 45 cents. That warrant me to put up inside and out of that money, Now, does it really matter if it continues to go higher? No. What matters is that my downside risk from the low was only 45 cents, okay? How much money am I going to lose? Did I buy these contracts up here when these contracts were at a high of $40 and ride them down to 45 cents? Or the public, when the contracts were up here at a high of $101 and they got down to 45 cents, up and out of the money at a very low price to be on that S&P 500. But guess what? It took a number of days and weeks to get that down here. And once it did, we were putting a double bottom here. We had a horrendous correction. But this upside move has legs. And we're going to look to see if we can break above that 1200 handle, close above, right above about 1204, 1205 handle. And I will be happy to show you where that is in this particular cycle. In this particular cycle, I will show you again in our system where the upside would go. If you could break through that 1224, we start getting up around that 1238 handle, that 1246 handle, right below that 1215. You got 1248 that comes in there. You got that upper pressure, that upside resistance from that last reversal. But each reversal, I've got these lows coming into play that are higher than that low. This low was higher than that low. And this low was higher than that low. That's ascending, man, within the overall couple of week structure from the dog days of August going into the worst part of September right here and now. And I am buying that. I am buying this $1,250 call right here, right now. Already own it from the previous day at the low. Look at all the risk is out of it. So, as we break out on that daily engulfing price action bar from that very negative divergences, as they ascend and increase, that's why these pullbacks are viable within the upside volatility, downside volatility, upside volatility. The volatility is here to stay. We said that in the beginning of the summer. And learning to trade volatility is the gift of entry and exit and understanding a deflated market versus an inflated market. And then how do I take advantage of these volatility bottoms at 52-week lows in the S&P 500? And then how do I get way over here and make the big profits? Another 300 contracts bought at $3. Remember, they were 45 cents. Up and out of the money is how you make thousands with 11,738 contracts traded on the 1250 call. Up and out of the money. And how would I know how to do that? How would I know how to apply that bottom to that trade? Once again, that 60-minute chart. This is the 60-minute half bar right here. 12.0, what is it? 1190. Here, let me get it. There it is, 1190.23. There it is. Go back to stockmarketfunding.com over the weekend and look at all the sector indices and look at the analysis when we were buying down here at the bottom yesterday, but what the analysis was over the weekend so that you can learn how to populate the diamond breakout, but that 60-minute broader view of it with these bottoms, how to apply them is what counts in bear markets. Bear volatility, bull volatility, bear volatility, fear volatility, index fear volatility, complacency, trading volatility ranges that people do not know how to do. And it is here to stay. And it's a new way for people to understand that this price volatility up and the short volatility down with the reversal volatility up, and how they make bottoms is a perfect recipe for that apple pie to create lots of all-time great debits within the trading structure and understanding. Here's our daily chart. Understanding. This is ours. I'm going to go in here. I'm going to populate it. Bam. There. I got all the lines. This is a daily chart. Each one of these are $16.92 per line. This is what we're doing right now. We're almost up 2 half deltas, almost 1 full delta in our pricing control. That's called delta expansion. You had it on the way down. Now you also got to have it on the daily upside. And as soon as I calculated it, that was a big green bar, but the 10-day moving average has crossed above it. It never did. On the pullback, that 10-day moving average never did roll over. That's clue 1, my MMTs. The other clue is, and here's your daily bar right here, 1192.7. And you're above this half bar. This next half bar is going to be the key. Can I close above that 1204? The upside here in the delta range, when we take a look at where we are right now exactly at a 1192.71. That's where we're at. So we're almost up a full delta on the S&P. 1199 will be our next area of resistance. A close above 1 1/2 delta to the positive on a daily is 1216. A 2 full delta is 232. A 2 1/2 delta is 1249. We're right in these areas, right back up here at the high end. That exasperation bottom on this daily MMT. Remember, we own this platform. It does not lie. And it changes every day. And it's 16.92 per line. And we're right there. And we're above that half bar on that daily. Because we are. And the thing about it is how the bottoms get put in. It's all about how bottoms get put in. It's all about how that daily bottom constructive part, how that was constructive, how the highs were be taken out, how they double bottoms, how the teeny expansion. It's all in here to the upside. We got to break those highs. If we invert, gap down toward these lows, then it's a different story. The S&P has a lower handle, believe it or not, going throughout the year is around 960. There's a handle between the next handle, so it's 1020. It's about 960 on the S&P. So you got 1020, 960, but then before you get there, you got about 1062 on the downside of that S&P. If we were to ever break these lows, right now it's a 52-week. It's autumn. The dog days of summer are kind of carrying over into September. That's all fine and well. The thing about it is how do I take out and how do I trade a 369 daily reversal with the gap open up? And how do I take out all of this congested area with this attempted 52-week low bottom in the S&P? But how do I trade that short? How do I get these moves? And why do I buy these contracts where on sell? Now, that's the math on the S&P. Now, if I was to go the opposite, and I'm going to just take a look down here, that on this particular SPX, what I am going to take a look at is, yeah, there is a 1063 with 3 full delta down. If we do break below 1097, we got 1080, we got 1063, 1046, 1029, 1012 at the current level that we would be looking at negative 4.5. But remember, the pricing on it's going to change every day. It's not going to be the same. It'll be relatively close. However, the SMF MMT platform on the daily mathematical calculation and trends will never change. They're accurate. You're above the 10-day moving average. That's a bullish tone on this bottom. For right now, the bottom is trying to be held, as we have said over the last few weeks, how that bottom would be put in. There's your standard chart. I could never make any analysis other than that second X. You need to break above it. You need to take it out. Everything that was in there. It's a 20-minute special. It's a 20-minute review. There's going to be lots of headline volatility.